Hi, everyone. I'm Kyle Ellicott, and welcome to Growing Bitcoin, a virtual series focused on growing your Bitcoin. We designed this series for Bitcoin holders, investors, institutions, and really anyone looking to explore new ways to make their Bitcoin a productive asset, including covering a lot of the emerging infrastructure, some of the newest yield strategies, and the greater institutional participation across the ecosystem and the wider Bitcoin economy. Over this weekly series, we'll hear from distinguished industry leaders from companies such as Bitwise, Strive, Stacks, Hermetica, Bitflow, and many more, each who will provide insights on how Bitcoin has continued to evolve, along with clear frameworks for earning on your Bitcoin. Insights from builders themselves who have put forth the work to build on Bitcoin and how they and other leaders are shaping Bitcoin finance or BTC-Fi. We'll also look at practical breakdowns of emerging yield mechanisms, the risks associated across the industry, and new rising opportunities, along with a better understanding of how institutions globally are approaching Bitcoin as a productive asset. With that said, please join us today to stay ahead of where Bitcoin is going, and let's start the show.
Good morning, everyone. Today, we're going to be hosting the Growing Bitcoin webinar. This is a webinar that Stacks have been particularly excited to produce, as the name in the game lately has been Bitcoin yield and Bitcoin institutional adoption of yield circuits and such. I'm Rena. I'm the COO of Stacks Endowment, and today I'm joined by Gordon Grant from Bitwise, where he leads derivatives and portfolio strategy. Gordon brings a depth of perspective on how institutions are actually thinking about Bitcoin today, how it's positioned in their portfolios, how it's positioned in their products, and more so how it is evolving beyond the store of value. Gordon, thank you so much for joining us.
Great to be here. My pleasure.
Jordan, maybe before we go into the ETF markets and such, what is your kind of overall landscape of the market just as a whole for Bitcoin? What are we seeing?
Yeah, sure. Well, I'll take a quick precedent to that to say, having come from a macro background where I traded emerging market foreign exchange and acted as a volatility PM at a multi-strategy fund for a number of years, I tend to think about the Bitcoin landscape today as it becomes increasingly institutional through some of those traditional financial paradigms, right? And I kind of divide the world between your world at Stacks, and you guys are very much the on-chain institutional yield mavens and have been there for a while making Bitcoin productive, and people like me that are developing innovative solutions for firms like Bitwise to create what we consider to be alpha sources to create uncorrelated return streams for this asset. But how are we doing that, right? And how are others trying to do it, both in your space and mine? Well, between the on-chain world, right, where we've got Bitcoin effectively acting as an asset that can sit inside a smart contract framework and be productive in terms of securing other types of transactions and interactions on chain, where essentially you get paid to make your Bitcoin usable by somebody else in some fashion to consummate some kind of contractual interaction. And in my world, where Bitcoin for the most part serves as collateral, either for a loan for folks that do yield type strategies, or as collateral for options. That's what I focus on. But I think that overall landscape is we've gone from a place 5 years ago when I walked in and started making markets for Bitcoin options at Genesis, and it was very much a cottage industry. There weren't that many places that you could get a quotation for options. There weren't that many accredited dealers. Concepts like qualified custodians or non-custodial wallets were still in their formative stages to today, right, where we have this panoply of centralized cash margin, highly regulated venues in North America, like options on IBIT or CME futures, regulated light venues internationally, such as Deribit, and then the over-the-counter world, which has always kind of been my expertise, right, where you're interacting directly under some sort of ISDA framework with folks. And then you've got your players, right? Bitcoin traditionally was just a bunch of guys that thought it was a wonderful alternative, to traditional forms of money and stores of value, and kind of the cypherpunk ethos, to today, where the cypherpunks, such as Adam Back, who's been in the news quite a bit lately, are turning their Bitcoin into a productive asset by placing onto the balance sheet of digital asset treasury companies. And those are some of the clients that I work with to help them generate yield and think critically about their Bitcoin strategy. So I would say we've gone from almost kind of miasmic origins of the space to this Cambrian explosion where everything has happened all at once. And now we have trillions in capital, we have dozens of venues, and we have essentially an infinite array of mechanisms by which you can trade, hedge, swap, and activate your Bitcoin in a number of different fashions in order to get some return for the risk that you're taking. And that's all the more salient because today, as we sit here looking at Bitcoin plus or minus 75,000, it's pretty much at the same level it was in about November of 2024. And not too far off the levels that it was just about this time last year when it was cratering around the tariff turmoil. So people have come to recognize that Bitcoin is, while very well supported and institutionally exciting from a trajectory of price perspective, it can sometimes do nothing for long periods of time. And when it's doing nothing, what are you doing with it? So that's the landscape is how I see it today.
I think that's great that you brought up 2024. So we started getting into the areas of spot ETFs around that time frame. And to date, let's start with today's numbers. We have $128 billion just in Q1 for AUM for Bitcoin spot ETF. It's about 8 billion in inflows this quarter or this past quarter and about 38 billion in inflows last year. If you think about it from like the 2024 perspective, the majority of that was retail and like self-directed accounts. But now I think institutional channels have opened up with RIAs and hedge funds and even public endowments and pension funds actually holding spot ETF Bitcoin. How are you seeing that landscape change? Are we now in an actual strategic shift or are we still momentum chasing?
Well, I think it's fair to say when we look at price having recently bottomed, potentially secularly, hopefully at least cyclically around the 60K point, or probabilistically, as I like to say as a mathematician, momentum that we saw last year where Bitcoin surged from those spring lows around the tariff bottom into fresh all-time highs near 125,000 has waned, right? You could essentially say it's been eviscerated in the sense of that verticality, that exponential upward momentum. That being said, Bitcoin at 75,000 is still orders of magnitude above where it was just a few short years ago, right? Going back to 2020, let's say, when Bitcoin bottomed around 3,000 during the pandemic pandemonium. So we've done a lot of good work in building the amount of AUM that's gone into this asset class. And indeed, the spot Bitcoin ETF has been a major vector of allocation here. I think what is clear is that money is still flowing into this asset, even when the prices are down. So it's not just folks banging up against the all-time highs, looking for Bitcoin to go from 125 to 200, 250, and on to that magical $1 million mark that many proselytizers from Melton Demers to Balaji and others have talked about for many years. So I would very much say that it is, in fact, right, institutional money that is underpinning some of the demand in this asset that has not let the bottom drop out of it that we've seen during past corrections. Yes, 50-ish%, 52% to be precise, peak to trough correction in this cycle is pretty gnarly when you think about the dollar value that was destroyed. But as a percentage, it's considerably less than some of the 70, 80, 90% corrections that we've previously seen in Bitcoin. So I think that's one, right? There's institutional capital flowing into the asset, but where else is there institutional capital? That's important for me to note. How about market making, right? So when we activated these ETFs, we had major firms, right? Your Jane Streets, Jumps, Towers, Virtues coming in to support the asset in a way that, although they were involved in crypto native exchanges, both CeFi and potentially DeFi, and they might have gotten a slap or two on the wrist for being in places that they oughtn't have, like Binance and other international regulated exchanges, they're now able to put all of their capital, if they want to, in order to provide liquidity into everyday markets. Again, IBIT Spot and other spot Bitcoin ETFs and spot crypto ETFs and places like CME, and maybe in the near future, even markets like Deribit now that it's owned by Coinbase and potentially could be accessible to North American UBOs. So that's another way. Institutional capital doesn't just have to buy the asset, for a long-term hold, it could put balance sheet to work in supplying liquidity to the asset, which of course, when you think about crypto, what does that sound a lot like? Sounds a lot like being an LP into some sort of DeFi pool, right? Same concept. Take balance sheet, put to work, provide liquidity, get a return. That's what these guys are all about. And that is helping to turn Bitcoin into the asset we all hope it will be. I think the last and probably most important thing about institutionalization is it's not just fiat flowing into these spot Bitcoin ETFs, it's in-kind creations. And even though this has been possible for some time now, I don't think it gets enough play. Why? Because when these things were created, they were cash creation products, right? So it was, if you wanted to get into them, you had to wire some money into a broker dealer. You go, I have got some Bitcoin. Can I get an ETF? And they would go, well, you could do it, but you sort of have to sell it and get cash and transmute it into this. It was kind of like bad alchemy, bad from a tax perspective, bad from a slippage perspective, bad from a customer or client perspective. And then all of a sudden, regulatory guidance changed and they allowed people to do in-kind creations and redemptions, much like we've seen in other ETF markets such as gold and precious metals. And for me, that was a big unlock, both literally and figuratively. Figuratively, because people are going, hey, look, now I can go back and forth between these two worlds as much as I want for a very modest toll, right? In basis points, you can measure that 5, 10, maybe 20. But it's also a material unlock because all of a sudden you've got liquidity that was trapped in the crypto native world, right, where people said, hey, look, I'm going to hold it in a custodial or non-custodial wallet. I'm going to be an OG forever. I don't ever want to move this. And people are going, if I could put it in a brokerage portfolio with a prime broker and I could borrow against it, I could trade other assets, I could use it as real collateral. It's fulfilling that promise that many Bitcoin luminaries have talked about, which is Bitcoin as global digital capital. So I think each of those things is quite important from a institutionalization and drivers of Bitcoin adoption, and then also making Bitcoin productive, right? When it becomes capital and not just a digital commodity or a digital currency, a cryptocurrency, it starts to change the personality of it. And with capital, you can do real things. You can invest capital, you can lever capital. When you just have a commodity or a currency, it's not really the same thing. And so I think that that is a very big and often overstepped or overlooked component of the growing trend of Bitcoin's institutionalization and how Bitcoin is being used for yield, for sure.
Well, I think we've definitely moved beyond the store of value in the digital gold narrative, or I would hope that we are moving beyond that narrative at this point in time, though gold has had its own run up and run down during this tumultuous period. But I think what really sticks for me is like what you said, the in-kind redemptions and the one-in-one. When I think about this, gold is an asset that people have historically invested in over the periods of time, yet it never bared a significant yield except for price appreciation. Bitcoin has the ability to do something else. You can borrow against it, you can do options, you can lever, you can LP and DeFi and go on chain. What are you seeing in terms of actual institutional behavior versus just the narrative of what we've been seeing in every past cycle?
Yeah, I would say there's probably a fair amount of bifurcation between folks that understand what on-chain activity is and can get comfortable with the movements of their Bitcoin from one place to another in a smart contract architecture and understand whether it's a borrow and lend type protocol like Granite that rides inside of stacks, whether it's a staking type of protocol, right, where you're going to lock it up and let it be cryptographically productive, or whether it's something else, as you say, like an AMM LP position, right, an automated market maker liquidity provider position that utilizes it as collateral to essentially get into a decentralized swap function on a bonding curve. That's a lot of gobbledygook for folks in the TradFi world, right? Even if they've got $100 million of Bitcoin, and these are the type of people that I tend to work with, it's a big reach for them to go, okay, I get futures and options and collateral and independent margin and variation margin and options driven income or yield. But that stuff, give me a year, a couple of agentic intelligent analysts to tell me what this is, get me a board resolution and I'll get there. So that subset yet is still not quite there. Now, that being said, institutional capital that is allocated to DATs in the Bitcoin space may indirectly be LPing into these types of opportunities because some of the DATs within their own mandate are surely going to explore this type of stuff. In fact, right, there are some DATs out there that I've talked to recently that are very pilled on using the Stacks ecosystem to generate yield for their strategies. And that's not to promote them at the detriment of others that have not mentioned Stacks, just to say that folks are looking at Bitcoin on chain in the DAT space as a potential avenue. And so even if you don't understand it, if you've allocated to a DAT, either via fiat or Bitcoin, the DAT becomes your de facto manager, and the manager may, in his infinite wisdom and discretion, get into this space. So that's kind of one side. The other side is Bitcoin OGs that tend to be, in my experience, quite conservative about what they do with the asset because the HODL has been the alpha for so long, are slowly warming up more and more to what some of my earliest clients at Genesis knew well from 2021 onwards, which is just because you want to trade a derivative strategy on Bitcoin doesn't mean that you're being reckless or irresponsible with it. You're not giving away, the moon boy hodler mentality simply because you might sell a call option against it. In fact, maybe you're the biggest moon boy of all because you take the premiums from the call options and you recycle them back into Bitcoin and compound your balances, right? Whereas a pure play hodler can't do that, right? And Stacks obviously has been on that game of Bitcoin into Bitcoin and compounding for a long time. So I think the non-on-chain proficient set is increasingly willing to embrace this. And then the question is, with whom are they embracing it? And yet here again, we're seeing a number of different players, some that might be unexpected, right? Goldman Sachs has mentioned that they're coming up with a Bitcoin yield ETF. We've seen a wrap note from the likes of JP Morgan. BlackRock has indicated that they're going to have a Bitcoin premium ETF. We've got other names like Grayscale that have dipped a toe in this water, although not to a meaningful scale, no pun intended. And we've got some odd names like Round Hill Partners, which did a Bitcoin income ETF, and others like Neos that has one that's been pretty successful in racking up significant AUM. Your flavor really depends on what you expect from your manager. Folks that are allocating to that space don't always love the idea of somebody hitting the shift F9 and banging out a bunch of options programmatically every month, much like the futures rolls transpire inside of ETFs. They want an active manager, someone that's been doing this a while with a track record. And there enter folks like myself and the Bitwises of the world and our competitors, where we go, okay, so you see that thing happening over there that's done by that half a dozen players that have, the new tombstones and all the marketing and advertising documentation. Great. They've been doing that for 3 months. We've been doing this for 6 years, right? And you come to us and you talk about a bespoke solution, a custom tailored suit, something that's got, unbuttonable cuffs and has been made to, fit and measured to the sizes and needs of the appropriate clients. But ultimately, at the end of the day, I think the commonality between on-chain proficient, CeFi comfortable, and yield sympathetic allocators is that they realize that, probably at least in part, that this drawdown has been a little bit more significant for most, and certainly more than the past because of the dollar value of the erosion of principal, that they need to be more fiduciarily prudential in their decisions, and that it's not okay to wear a 50% markdown from an asset that was a multi-trillion dollar asset at its peak. And even though 50K off doesn't sound like a lot for Bitcoin, we've seen that before. 50K when it's 40% of several trillion dollars just doesn't feel responsible anymore. And this is the foil to that sense of perhaps a dearth of responsibility.
Perhaps maybe we could talk about how portfolio managers assess different types of yield because no yield is the same and such. And us as stacks or me building protocols with our ecosystem always are thinking about what type of yield should we provide, how should we structure it, and what are the guardrails needed for portfolio managers to feel comfortable. Like you said, TradFi had very significant architecture and rules in place as to what can and cannot do, but when you're coming from the on-chain world, it's a little bit more opaque and you're trying to retrofit your protocol into, let's call it, rules from the past and trying to marry the two. What would you say is the most important areas for yield in terms of risk versus reward?
Yeah. So from the set of folks that I talk to, regardless of whether they're willing to consider on-chain yield or they're CeFi only, over-the-counter or listed derivatives, options-driven income, or maybe even something lower risk like basis trades, perhaps, or rel val borrow lend type strategies, which they view as lower risk. I may not necessarily. That's just a perspective that I get from some folks. They're all about return of capital as a conditional prior before we get into return on capital discussions. And I think that that's characterized the Bitcoiner mentality for a long time. One Bitcoin equals one Bitcoin. You got to be able to give me that back before we start talking about anything else that we're doing. Now, there's no reward that's achievable without taking some measure of risk. And then the question becomes, I think for most folks, can you quantify that risk? I like to get on my little soapbox and say, well, in the derivative markets, I'm aided and abetted by pricing transparency and all these Greek letters that just tell me exactly how much risk that I have under some set of mathematical assumptions. So it makes my life as a PM a lot easier. And I can go, great, delta, gamma, vega, rho, theta, vana, volga, right, all the way down the list and go, that's my risk, right? Trust me that this is there. And the probabilistic expectation of outcomes is the following, right? Based on the data set and the positionings and experience as a manager. So I think people like that. And then they go, okay, so for how much risk can I get what return? What's that relationship like? And people start to ask the traditional questions. Are you a 2 sharp guy? Are you a 3 sharp guy? Are you telling me something pie in the sky? You've got 4 sharp, which I would never say with a straight face, but some people in the market neutral world have done that. And people kind of feel like there's a sweet spot there where there's the too good to be true stuff, some of which blew up after October 10th last year, right? Unfortunately. And then there's the, okay, interesting, but maybe there's a sweet spot, right? Where I could be really low key kind of participatory, right? Where you might, let's say, even lock your Bitcoin in some kind of life insurance policy, right? That's out there now. People are doing that and they're getting a little bit of yield on top of that. Or they're doing some of these kind of low stakes staking where they get 0.5%, 0.25% on the Bitcoin, or maybe they get paid a little bit by an accredited exchange as a depositor. And that middle ground is where it starts to get interesting. But they all want to know that. And when they talk about risk, they want to know, okay, so not just your Greek gobbledygook, to reuse that word, but also maximum drawdown, right? Liquidity. How quickly could I unwind or have you unwind the positions as a manager? That's all the kind of stuff. Now, when they get to on-chain, I think is where the bigger burden of proof is on the stacks of the worlds and the others that are doing this. And you guys, to your credit, I think through webinars like this and through materials and other stuff that you disseminate, you've done a great job of trying to explain something that's not that intuitive, right? How do you explain risk in a smart contract sense? Of course, it's susceptible to hacks. It's susceptible to, bridging specific risks. It's susceptible to smart contract performance risks. Just how far are you expecting that Bitcoin to go for you in terms of what it's being asked to do as a financial backflip as collateral? Are you using it to borrow stables and then LPing the stables, right? How many steps down the chain, figuratively and literally speaking, are you moving that capital to get the return that you're being promised? And that for most folks is where the waters start to muddy a bit and they bump against abstruse concepts with which they're not quite familiar. And so that burden of proof, right? That demonstration beyond a reasonable doubt that there is fiduciary prudence being implemented is certainly an important part. What I can say is that the return expectations on a net basis for the institutional Bitcoin allocator is a lot lower than almost any other asset that I've seen, right? Which is to say, if you're talking 3 to 7 net on an annualized basis with a Sharp that's in excess of 2, you're going to find some very happy allocators, right? If you can actually deliver on that. That's what I think that I'm out there to do, right? And that's what I believe is responsible and prudent. I tend to talk about gross returns because every asset management agreement for an SMA maven like myself is a bit different. But indeed, if you're talking about gross returns that are in the mid to upper single digits and maybe in a great year in the low double digits, you're going to keep people very happy. And I think that resonates kind of with the same returns that you guys have talked about for some period of time, right? And the risk. Obviously, a return and a Sharp imputes the degree of variance of the strategy returns. And the last thing that I would say here, which I've assumed into this discussion, but may not be obvious to a lot of the folks that come from a traditional finance background is we're all in Bitcoin denominated returns here, right? I've totally abstracted fiat from everything that I say, and I always do that. And sometimes that in and of itself takes people a second to go, huh? Wait, where's the dollar in all this? And I go, look, one Bitcoin is one Bitcoin. How much do you start with? How much do you end with? How much is the variability of your revenue streams and your principal balances when you talk about it in Bitcoin terms? And that for me is something that as a Bitcoin adherent, I've been kind of trying to inculcate for a long time. And I feel like it's only within the last 12 to 18 months that people have really started to get it, right? Where they go, okay, I'm not so worried about the dollar value of the Bitcoin. I'm just thinking about the amount of Bitcoin that I have and what my variance is with respect to that as a numeraire. And so in some sense, it's going to start to clarify our job as managers, as protocol builders like yourselves, where people go, that dollar thing there, I'll sort of care about it later if I ever want to cash this out or I need to hedge it. But what I really care about is Bitcoin into Bitcoin, yield, variance, risk, and other relevant metrics.
I think for me, the most important thing as a protocol that we can do is provide different areas of yield that people can seek. So I love that you brought up CeFi and lending, native protocol yield, staking, basis trade. All of these are actually products that are being built on Stacks by our really wonderful ecosystem of builders. I'm going to give some of them a shout out because they deserve to be highlighted and seen. So on the basis trade, the trade that most of us as traders have always done of doing the funding rate arb for futures and spot, there is a vault product from Hermetica that does this automatically. So not everyone is as lucky to have a Bitwise asset management trading team on the other side, but this is a way that people can implement the same strategy purely on chain. On the lending side, you already hit my favorite protocol, Granite, but there's Granite and Zest where you can borrow against your Bitcoin in a safer and more secure, risk managed way to get a stablecoin loan on the other side. What you choose to do in the stablecoins, whether you are LPing into something else, borrowing to buy more Bitcoin, or actually just straight up putting it in T-bills is another way that you could actually earn a yield. And then my personal favorite is the native protocol yield. As you all know, Stacks has had a history of giving out a native protocol yield through staking. When you stake Stacks, you earn Bitcoin. And we've had an on-chain history for maybe 5 years, giving out 4,000 Bitcoin. So the on-chain receipts prove exactly what it should be. And I think that is probably the most underutilized channel by and far for asset managers to look at because it is a lower risk yield, though it doesn't have the DeFi architecture set. So you have something a little bit more steady compared to being beholden to price action. So that's something that I always want to highlight about Stacks and where institutions could actually work with us to actually grow their Bitcoin accumulation.
Yeah, definitely. And I too feel like it's underutilized. And it's one that I often mention into my discussions with folks. And they say, well, who do you really rate as your competition, right? Is it another XYZ SMA manager? Is it, ABC fund, crypto fund? Is it one of these new, one, two, three ETF products with yield? And I actually often go, look, if you really want low risk and you want to get yield that you can have confidence in based on a 5 year plus track, go look at stacks. And then the people go, so how does that work? Right. And then you give them the cryptographic explainer. And that's when their eyes start to kind of goggle a bit. And I think, just as is true for me, when I go to someone and say, okay, so I can give you this type of income stream, this type of return. And they go, so how do you do it? I go by trading call options and selling them in net. And they go, well, that doesn't work. How can you give me yield and make a return consistently when Bitcoin can go up 50%, 100% a year? And I go, well, look, let me explain to you here's how. There's a burden of proof on us as generators of alpha to, in some sense, convey the substance of the magic that we do, right? Because folks go Bitcoin and Bitcoin yield through on-chain, staking on stacks or through trading of derivatives, even though they're totally different in terms of what we're doing. We have this burden of proof to people because it feels like it shouldn't be possible, right? In the way that it is. But of course, once you understand what Stacks does, or once you understand how a dynamically managed call trading strategy does, then it comes to make sense. So you have to hold people's attention a little longer, I feel like, in both your shoes and mine, to kind of get them, over the hump. But once they're there, they find that it's a very happy place that they're in. And I think that I would love to be able to tell people before very long that I too have generated 4,000 in Bitcoin in earnings for people. But I've got a little bit of ways to go there. So, once I get into the multiple thousands, I'll give you a call.
Well, you know what? You can just build with Stacks and then you already have the leg up. Simple enough.
Absolutely.
Maybe as we're coming towards a close, I think what a lot of institutional allocators want to understand is we're in this awkward, let's call it sideways market. How should they be thinking about yield in this particular market? Because we're not in a full bull market where we're going to be at 100K just quite now, but we're not drawing down to 40K either. We're kind of hovering in this awkward 75K position. If you're doing the funding rate yield, the funding rate arb, you're getting compressed. Where should they be looking? How is Bitwise and your products supporting them? And how are you thinking about the strategy at this market?
Yeah, for sure. Well, I can say the primary focus has continued to be on generating a responsible rate of return that doesn't blindly give away the upside in the event and when eventually, right, Bitcoin resumes what most folks hope will be a happy upward trajectory. And through the Sturm und Drang of the last, 6+ months since the October 10th flash crash, it's actually been a relatively easy going to do that because Bitcoin has had elevated implied vol, right? It rocketed in the fourth quarter along with variance risk premium, which of course is the spread between Bitcoin's actual variance and its realized volatility. Um, and implied variance, right, and its actual realized volatility. And overall, right, Bitcoin was hanging in the 90s throughout much of last year and into the beginning of this year, and even the first week of January was a field day for this. And then it's gotten harder, right, because price fell out of bed, even though volatility elevated. You still had good opportunities, but you really had to have a lot of conviction in the trades that you did because obviously selling something like 100,000 strike calls that are 4 or 5 months away from time to expiry when Bitcoin is 70K or 72K coming off a 60K bottom is not that easy for most folks because it feels like it could go back there tomorrow. The update is that those have been terrific trades, but guess what? Vol was 50 when we were doing those types of strategies. Vol is now closer to 40. So it's gotten really hard, which is to say price is still down 40% from the highs. Volatility has compressed from implied volatility from the 60s when Bitcoin was at its nadir to about 40% where it is now. And we're sort of in a place where funding on futures in the very front of the curve in particular perps is negative. Basis has really gone out of the system. There is no skew for out of the money calls versus out the money options or, indeed further out of the money calls, right? It's just a very flat smile. So you're now increasingly forced to make difficult choices. And I think actually this is the time where responsible managers should be contemplating calibrating carefully the risk that they take, particularly in a derivatives driven portfolio, because there are a lot of what I call UUs, unknown unknowns. We're in the midst of a geopolitical conflict that has racked the Middle East and the rest of the world. It's detonated supply chains. It's caused no undue amount of pain for consumers at the pump. And it's also forced us to ask questions that we didn't understand heretofore, such as what are the linkages between, a surge in oil prices and the stock market? Well, the answer is the stock market just hit all-time highs yesterday. Is that going to be sustained? Who knows? What should Bitcoin do if oil is elevated, but stocks, are at highs? VIX has gone from kind of 15 to, almost 50 and then back to 20 again. So there's a lot of static in the system, an increasing degree of uncertainty about what we actually think we know. And therefore, the kind of lean as a manager now is to say, we're getting on 4 good months of this year, right? And having 4 good months of a pretty nice tailwind in any kind of tactical strategy is about as long as you can expect before you need to start to look over your shoulder for the boogeyman. And I'm starting to feel like there could be a boogeyman in the offing. Positioning has gotten a bit complacent, I think. There appears to be an inundation of overwriting in the options market when you look at the gamma profile across the dealer community and the street. Implied volatility has come down quite a lot from where it was, and it echoes, in some sense, to me, what happened last year during the tariff turmoil. We all remember Bitcoin again was in the 110 type level through January. It fell out of bed to as low as about 77 when the world financially looked like it was ending with as much as 120% tariffs on China. The world didn't end, the sky didn't fall, and Bitcoin went from 77 to about 112 in a 5 week period, right? Pretty rip snorting rally. And volatility sellers, particularly those folks that elected to sell volatility in programmatic fashion with their eyes closed, might have lost their shirt. As an active manager, I still eked out some small gains, but it was one of the toughest times that I ever had managing a net short options portfolio throughout that window because implied vol went from the upper 50s when spot was at 80 to as low as about 40% when spot got up to around 95. And that 95 to 112 window throughout the May period was certainly very challenging. And I think, although I'm not certain, there are risks that we could have a replay of that, maybe not all the way back up to 112, but a move to 85 or 90 might catch a lot of people off guard here. So I'm thinking, really about seasonality, cyclical calibrations, variance risk premium, right? Bitcoin has been moving around in these erratic oscillations, even though day to day for 3 or 4 days at a time, it might not do much, right? We've kind of ratcheted back up here to 75 and we're just inchworming along. It can have another step function and you don't want to be caught off footed when it does. So, overall, I think prudence and discretion trump valor and ego here. It's been a great few months for the strategy. I think in any given year managing this kind of strategy, you have to take your wins when you can, reset when the conditional expectations are not as good as they were. And clearly at 40 vol was spot at 75. It's not nearly as appetizing it was with vol at 50 and spot at 72 just a few weeks ago. And to your point, look at other ways to generate yield, right? I don't have an ability to put stacks solutions into my strategies. But if people are asking me, well,
Yet.
if you think
Yet.
that's right, yet I don't yet have that ability. Where can you go? I think the answer is you have to look where you're getting the right amount of return for the risk that you're taking. And clearly, you're not getting as much return for the same or greater risk here in the options market. We may well see an opportunity to do overwrites again with vol at 50 and spot, let's say, in its upper quintile of the trailing 1 year distribution. I'd love to see that. But in the meantime, I think you need to think about other opportunities out there as a complement, not as a pure substitute. Clearly, I'm not hanging up my hat and saying go away on summer vacation and don't trade this strategy at all. But just to say, we're thinking more critically about relative value trades throughout the term structure within the smile itself, as well as more tactical trades. It may be the case that you don't want to sell options and sit on them until expire. You want to bank those gains and move them around more dynamically. And so I think it's the time to pull in the reins a little bit, take one's foot off the gas, perhaps tap the brakes on the risk that one has been running. At the end of the day, Bitcoin is still 75,000. It's still where it was on November 8th of 2024 when there was this historic election victory for a very pro crypto administration, which is now in full force. And many of those promises have come to fulfillment regulatorily, even if price has kind of treaded water. And it would seem to be a bit short-sighted to believe that Bitcoin doesn't have the ability to kind of rip everyone's face off again and sort of go back to a much higher level in searing fashion, as is its wont. Of course, we could go back and test 60K again, and if it does, I won't be caught underallocated either. But you have to respect this asset, and I think respecting the asset in part depends on making it work for you in all the ways that it can. And to be sure, there are lots of choices out there, not just basis or covered calls or indeed borrow and lend, but all the beautiful things on chain that you and others have built.
Well, I think on that note, I think we're all looking forward to hopefully a more maturing Bitcoin capital markets as time goes on. We are already seeing signs of it from everything that Bitwise is producing, as well as other asset allocators and thinking about how they should hedge their Bitcoin and how they should actually use their Bitcoin to be a productive asset. Gordon, thank you so much for joining us. This has been exactly the type of conversation that I was hoping that we could have. And so thank you very much. For everyone joining us, I just want to say thank you. Please follow Bitwise Asset Management on X. Gordon, how should people find you on the web space?
I tend to keep a lower profile as an alpha manager to ensure that we're not leaking too much of
Of
that
course.
treasure that we allocate to our clients. That being said, there are a number of materials that are disseminated to institutional investors. I also make my way to a number of speaking engagements, such as Strategy World, where I was earlier this year. I'll be at the Las Vegas upcoming Bitcoin conference and other venues. So key in for opportunities like that, as well as XCast or podcasts with Mr. Matt Hogan, of course, who's the CIO here. Love to take the opportunity to have my brain picked by his and have a free exchange of information and ideas to the benefit of all the listeners out there. And of course, hopefully for upcoming stacks, driven webinars where we can dig a bit more deeply into what I do, what you do, and hopefully at some point what we're doing together.
That's the best way to end it. Everyone, thank you very much. Please stay connected with us on X. The next webinar will be on April 28th, and we're looking forward to continuing this series.
Swell. Thanks, Rena. Thank
Appreciate
you.
it.
Thank you all for joining our Growing Bitcoin series focused on growing your Bitcoin. We hope you're encouraged to get started and start building. And in the meantime, be sure to check out the Stacks calendar for the latest happenings across the Stacks ecosystem, and be sure to follow Stacks on X for the latest news and updates across the ecosystem as well. Until next time, everyone, take care. We'll talk to you soon.